Now, at year 0, so we can have assets. We can have, sometimes you can call it an initial outlay, class. You can actually call it what? Initial outlay, right? You can call it what? Initial outlay. Initial outlay, which is at year 0, 16 million. Right? Or, okay, I can decide to remove the 0 if everything is in thousands. But because of one or two reasons, I will not do it like that, because I'm seeing it that some of these things are not like that, right? So if this is your initial outlay at year 0, you may decide to bring it up like this, or you can decide that it doesn't presentation of what is it called, or capital budget does not have one specific format, right? That you must use this, you must use just like PM. Now, I can decide to start with, let me start with sales. Let me start with what? The sales. So I will need figure from you guys, please. I want you to call the figure so that will be okay. I would like you to call the figures, please. Screenshot this part, screenshot the sales value. So you just give me figure. Then we'll move from there. So are we good with that? So after this, screenshot the variable cost. Are we good with that? After the variable cost, please screenshot the fixed cost. Then we move into working capital later in the day, right? Now, what is the sales? Class, give me figure for the sales. Hello?
13,250,000.
Okay, 13,250,000. Okay. Please give me figure.
60,695,000.
Okay, I'm coming. 60 million. Just a minute. Let me do this thing like this. Okay. Okay, 60 million what? Sorry.
16,695,000.
Okay. 16,695. 695,000. Okay, next.
22,788.
22.
788.
Okay. 22,788.
675.
6 what?
75. 675.
675. Okay. What of the last year?
31.
31.
105. 870.
105.
870.
870. So we have the variable costs. Right. So the variable cost, what is the variable cost?
5787. 5,000,000.
5,000,000.
787,600. 600.
787,600. So next.
7291.
7291.
740.
72.
7,000,000.
729. Okay.
740.
Okay, 740. Thank you. 740. Okay. Next.
9,000,000.
Okay, 9,000,000.
952.
952.
605.
605. Next,
30,000,000.
13,000,000.
583.
583.
291.
291. Please, presentation matters a lot. So please, you can see the way I'm presenting my work, right? The name of the company, your Naira sign, and all that is very what? Is very, very important, right? Please, let's take note of that, right? Now, after this, there is fixed cost. We can say less all these parts. We can say less so that we'll save ourselves stress. Less this. We can say less fixed costs, right? We can do less. Okay. Okay, I'm with you. Exclusive.
Good afternoon.
Good afternoon.
So please, I want to know why we are recognizing fiscal since it's not.
They say it's incremental. It's incremental fiscals. It's increased in line with. Sure, you did incremental fiscals. You can see it here. You can see incremental fiscals. Don't forget, when I was explaining the relevant costing, I told you that fixed cost is fixed. Is it relevant to the project? Establish that first. Is it relevant to the project? Is it increasing on a yearly basis? Yes. That is why you have to recognize it.
Okay. Thank you.
Do you get?
Yeah.
Okay. Thank you. Exclusive. Exclusive.
Sir, I did with.
Next. Rachel, Rachel. Next.
900,000.
Okay. Where is the other lady? She's not calling figure for me again. 900,000. I see, or because I did not do you Valentine something. What? Where is the other lady? She's not calling figure for me. Okay, it's fine. So, okay, 900,000. After 900, what do you have?
945,000.
945,000. Next,
That 90,250.
that is what?
992,250.
992,250. Next,
250.
next,
1,000,000
1,000,000
and 41,000. 041.
of 041. That's all right.
863.
863. God bless you. Now, the next relevant cost, they talk about, they made mention of marketing expenses. And that marketing expenses, it will be only applicable in what? In year one. And it is allowable for tax. Marketing expenses. So I need to know the figure. Year one. So you can just put only one less instead of putting less, like where we know the primary school. So we just put only one less. So it will cover all this. Right. So the next one is the marketing expenses, right? So now let's check. Let's check. Why is this thing? Let's check the marketing expenses. Marketing expenses. So what is the marketing expenditure here? You can see the market. What is that? What is that? 1 million, right? 1 million, right? 1.5 million.
Yes, sir.
Good. Okay, so it will be 1.5 million. 1.5 million. 1.5 million. Right? So if that is established, so we need to get our net cash flow before tax. You don't call it profit here because it is cash flow, right? It is what relevant cost, right? Now, net cash flow before tax. Please remove everything. What do you have? Net cash flow before tax. Remove it. What do you have? What is the net cash flow before tax? Is someone should do for year two, the other person should do for year three, year four, so that we can we can move. Figure.
For year one,
Okay. For year one, what do you have?
5 million
5 million,
62,400.
62,
Zero
62. Okay, 0, 0, 6, 2.
400.
0, 6, 2 what? 400. Okay. Okay. Next. Are you the only one in this class? Ha. Okay. Figure.
8728
8728.
260.
2260. Exclusive. You call figure for me today. Thank God. Next. Right. I must commend you on your consistency, right? You've really been fine. Well done. What next do we have? Year
11
3.
million.
What do we have?
11 million
Okay, 11 million.
843
11 million 843.
820.
Okay, 820, right? 820. Next.
16
Okay.
479 207.
16 what?
479
479.
207.1.
207.
207. Let us say 207.
Okay, 207. Okay. Okay, that's fine. So, if this is established before tax, right? What next do we need to charge again? Don't forget that we have working capital. We have your tax savings on your capital allowance. Is that not so? So that is tax savings, what the relevant tax authority will give you. You don't need to consider it before you tax. No. Then, what else do we have? Working capital. You cannot tax working capital. What else do we have? The initial cost. Now, I didn't mean you have a sales proceed now at the end of the year 4. I didn't mean you have a sales proceed at the end of year 4. You would have included, because when you sell, you make a sales, so you pay tax on that. Is that not so? We should understand how these things work. So now tax is 25%, right? So let me arrange all this. After you charge your tax, you have net cash flow after tax. When you have a net cash flow after tax, so you can now bring in your the asset, right? You can bring in the asset. When you bring in the asset, you bring in your working capital. When you bring in your working capital, you bring in your tax savings, right? After your tax savings, your DCF, they actually mentioned it. The cost of capital to be used is given. After that, you have your present value. So when you calculate, you have your NPV. You don't write NPV like this in example. It's net present what? Net present, net present what? Net present value, right? Net present what? Net present value. So class, what do we have? So let me quickly put this as initial outlay. Okay. Initial outlay is what? 16 million, right? 16 million.
Hello,
16
sir.
million, right? Yeah, I'm with you.
Please, are we not going to tax these cash flows?
Which one?
The cash flows.
And that is why I say tax now. You do tax 25% on all those cash flow.
Okay,
The net
okay.
cash
I
flow
didn't see it.
before tax.
Sorry, sir.
Okay. Okay. Aga, we go fight. So now this is your this. So the working capital at year zero is 1,025,000, right? So I need to get the figures for every year. Okay, let me check something. So please screenshot this part, 41,000, 41,053. Please screenshot, you give me figure, please. Okay, now the first one is 41,000. What is the next? What is the next figure? What is the next figure, class? Quickly. 53, 53 what? Class.
53,300, sir.
Okay, 1,300. Thank you. What next? What next do we have?
55,965.
55,965. 55,965. So at the last year they recoup it. So what is the total amount that they recoup that we calculate? 1 million what? What is the total amount?
1,175,000.
Okay, 175,000. 175,000 what?
265.
Okay, 265. Right. So what is the tax savings? So where is the tax? I'm coming. What is the tax savings? Okay, you can see the tax savings, right? 800, 640, 512, right? You can see the tax savings. Now, class, I have mentioned it too, that I didn't mean you have a sales proceed. You have to tax it. You have to include it maybe after your what marketing expenses, right? Please, I've mentioned it before, right? Now, what is the tax savings for year one? Inflow, 88,000, right? What of year two? What of year two?
640.
640. What of year three?
512.
Okay, 512, right? 512. So the last year we don't have anything, right? So there is no tax savings in that year. So you do your DCF. So how many percent did they give us? I think it's about 11%. You can see in these questions, they did not even say you should do the appropriate cost of capital or cost of capital to determine the cost. You can see the cost here, Abby. You can see the cost. So class, um, I will get back to, I will send a message to the platform if we are going to continue this class, right? You know, I've been saying it that I've been having some challenges so far, right? So I will send a message to the platform if we are going to continue this class shortly. So I just want to look for a way. Okay, now we need to, where are we? Okay, so we need to do what? We need to get the net, get the tax, right? We need to do the tax of this. Please give me figure. What will be the tax? Don't forget that this is the net cash flow. This will be the net cash flow. You charge 25% of it. This is the net cash flow. You charge 25%, this 25%, and this 20. So please give me figure. What is the 25% of this? Figure. Hello?
1,265.
Okay, okay. I'm coming. So this is one,
1,265.
one, two,
65.
six, five.
625.
1,265,
625.
625. Okay. So that is the what? That is the tax. right? And it is calculated on what? It is calculated on the net cash flow before tax. Class, it is calculated on what? The net cash flow, right? Now, we calculated the tax on all this. Please, year two, give me figure.
2182065.
Okay, I'm coming. 2, 1.
2182065.
The year one should be 600, not 625.
Okay.
This
Next.
one is 500 now. This 062500.
This answer, wait, I'm coming. 25% of 062, is it 400 or 500?
500.
500. So what do we have now?
625.
625. Madam, please, can you confirm?
Yes, it's fine.
Okay. Next, 25% of
2182065.
218 065.
2182.
Okay, I'm coming. 2182
065.
2182 065.
Yeah.
Please, Madam Linda, please, can you confirm that again? If we are good. Next. Why she confirm?
2960955.
296095955.
55.
Okay. Next.
4119.
4119.
802.
802.
Yep.
So that is the net tax, right? That is the what? That is the net. That is our cash what? Our tax on this, right? So we can now have net cash flow.
This tax savings is 800,000.
Is it
Yeah,
100,000? Okay.
Mm-hmm.
Okay. Thank you. So you can always correct it when I send the document to you, right? You can always correct it. So next one that we have here is net cash flow after tax. After tax. Tax class. So how do we get the net cash flow after tax? When you please minus this from your net cash flow before tax. Rachel, thank God. Rachel, you are back, right? Rachel.
Yes, sir.
Okay, thank you. Welcome back. Please give me figure. Net cash flow minus your tax paid. What do you have? What is the net cash flow after tax?
I think 3,796,875.
3,796,875, right? Please, someone has to confirm the figure.
Yeah.
Okay, that's fine. So next, what do you have? Next,
6546195.
6546195. Right. So please, what do you have again?
8882 865.
8882865. Right, please, someone else should confirm the figure. Next.
12,359,405.
12,359,405. Please,
Yep.
someone else should confirm the figure. So the DCF. So please, let's do the DCF. So this will be 1, which is year 0, right? Class, this will be 1. Because when you raise, we'll say, some people did not know how to. Okay, let's say, what is the formula for calculating DCF? Equals to 1 divided by 1 plus R, 1 plus R, right? Open brackets, close brackets, raised to power of n. That is the formula. So please,
Or 1
if
plus
you put
r raised to power minus n.
yes or thank you or that, so anyone, right? It's just mathematics, right? So whichever way, we move on with that. So this present value here, right? Your DCF will be just add this year 0 together, all the year 0 together, the 16 million, this and the other one. Please add it together. What do you have?
17,022. 17,025. Sorry.
17,025, right? Because when you use n now, your n will be 0, right? Any number raised to power 0 is 1. So definitely everything will be 1. Any number raised to power 0 is what? Is 1. So we definitely have 1 here, right? So next, what will be the DCF? Please do this DCF for year. You can see the 11%.
0.990.
0.9.
Yeah.
Just say 1 decimal place. Let's just be consistent.
Okay,
Next.
0.9.
So someone should multiply by
0.8.
Oh, I'm not done yet. Sorry.
Okay.
Sorry. I'm not done yet. So please, I need figure for this. You have to give figure for all this. Give figure for all this. So you have your net cash flow after tax. Is that not so?
Yes.
Then you remove your working capital. Remove your working capital. Add your what? Add your net present. Add your tax savings. What do you have?
Year 1.
Okay.
4,555,875.
455,875.
4,555.
555. Okay. 4,555. Okay. Please, someone to confirm. Rachel, Madam Linda, right? And others. Please kindly confirm. Felicia, please confirm the figure before we move ahead. Use this. This is your net cash flow after tax minus 41 plus
Yes,
your
sir.
tax savings. Okay, are we good? So are we good?
Yes, sir.
Okay, thank you. Thank you so much. So next.
Yes, sir.
Let's move on. Next. So what is the figure?
Seven 132,895.
Sorry. 7,132,895. Hold on, sorry. 7,132,895. Next.
9338900.
Okay. Become 9338900. Next.
13534 670.
Okay. 13
5
5
34
3 4.
670.
670. Thirteen 5 4 6 7 0. Is that correct?
13534 670.
Okay, 534. Yeah, I'm looking for the last one. So, okay, now you can do the DCF for this. Please, what is the DCF? Quickly.
0.90
I hope,
year
I hope,
1.
okay, I hope we are getting it right.
0.81 year 2.
Okay, you can come. 0 point what?
0.731. 0.811 year
Yeah.
2.
Okay, year 3.
0.731.
0.7.
7
Year
yeah.
3. Year 4.
0.658.
0.658. Okay, please multiply so that you will have
4
your present
million.
value. I'm coming exclusive. I'm coming. Okay, so what do you have?
For 17 million year 1. 17025 year 0. Sorry.
Is there already?
Year 1. 4,100,288.
100,288.
Year 2. 5784.
5784.
850.
850. Rachel, are you still with us? Moses, are you still with us?
Yes, sir.
Please confirm the figure. Felicia.
Yes, I'm here, sir.
Okay, multiply. What do you have? Quickly.
Which year?
Please. Yeah, 3 now, exclusive.
Year 3. 6826 734.
6826
734.
Okay, 734. Next.
8905.
890. Okay.
8905.
813.
813.
Yep.
So if this is the present value, now to get your MPV, class, to get your MPV, which is the present value, add your, since you have your positive from year 1 to year 3, add it together, minus it from year 0. Sometimes you may have negative in year 1, so you need to subtract it from the positive before you will now have your what? Your MPV. Class, what is your MPV now?
8592.
Add it from year 1 to year 4, then you minus it from year 0. What do you have?
8592 685.
Is it positive?
Yes.
85
92 685.
8592 685. Okay, that's a very good one. So what is the decision here? I need someone to tell me what if we are they say we should evaluate the financial viability, right? Now, what is the decision here? What is the decision here? Class.
Accept the project.
So if you accept the project, what is the implication? What is the implication to investors?
To maximize their wealth.
Okay, it will maximize what? The
Shareholders.
shareholders wealth, because it has a what? It has a positive NPV. Now,
Yes.
distinguished professional colleagues, right? Dear professional colleagues, you can see the way I present my work, right? See, you do see there is nothing you need again in NPV. The only thing that will be problem in NPV is all this the inflation rate, whether when you want to convert money cost of capital to, and I've actually explained that in our previous class, right? And this is how you present your work in what? In investment, what? In investment appraiser. Now take note of this again, that take note of another thing, that because we have different cash flow, that is why we decide to do it. There is another way of doing it. But if we have a single cash flow, now for instance, one cash flow from year 1 to year 4, we can use that method. Then we don't need to do year 1, year 2. We can use all these, their annuity formula that we use. Plus, this is how to present investment what? Investment appraiser. So this is solution. This is how you need to present it. Right? Some will say initial outflow first. Some will say this. Just present it in such a way that you will understand how you will get all those things. Class. So, do we have any question? If you have question for me, unmute your mic and ask your question, please. Unmute your mic. Lydia, Lydia,
Hello, sir.
water. Just give me normal water.
Can you hear me?
Yeah, I'm with you.
Okay, I noticed the present value for year 2 is 5,706,316.
Okay. Now let's go back. Let's go back and check. Is what?
5,706,316.
5 million 0
706
I'm coming. 706
316.
316. So if you notice anything, Rachel, when I send this thing to you, you can correct it. That is what exclusive gave to me, right? Please recalculate it. What do you have again? What is the NPV?
That figure you're giving, how did you? It's not. I don't think it's correct, because the net cash flow is 7132895. So start from there times
Multi
0.811.
0.8 multiplied by
Yeah,
0.8. What do you have?
let's even say 7,132,895 times 0.8. Okay. Me, I use two figures anyways. 0.811.
Okay.
So I think that's where the difference is coming from.
Okay. So quickly, what do you have again? Are we good?
Yeah, but if you use 0.8, it will be 5,706,316. But if you use
yes, now it's 0.8 we are using now.
yeah.
So please, what of the last year? We are not consistent here. This DCF that we use is supposed to be 0.7 because of the consistency. We've been using one decimal.
Okay. If it's one decimal, all these figures will change, but it will still be positive NPV.
So please, you have to change it in your notes, right? When I send this thing to you, just change it to because of consistency, right? So please, you will recalculate the NPV. I'm sure the NPV will still be positive, but the figure may not be what equals to this. So when you are doing it on your own, you can equally do what? You can equally correct the figure. So, distinguished professional colleagues, we have been able to what? We have been able to examine one of two questions. I think one of 2 to 3 questions that I actually want to solve. We have examined that. You can see how the question is, right? Doing it in Word, you can see how stressful it is as well. Hello, class. We can see how stressful it is, right? Right. And some of you, I don't know how I want to put it. It is so unfortunate that when some of you see free something like this, you take it for granted. And I wish every one of you well, right? Like I usually say to my team, and as well as to you guys as well, that Next Gen Professional Associates, the classes are free today. Uh, it may not be 100% free tomorrow. Please take advantage of this opportunity to move your professional career forward, right? And that is what we are doing. You can't see any center that will teach you. They will not teach you. They will do the workings already and this explaining to you that this is how they got this figure. And they won't tell you the implication of all those things, right? And that is what we are doing at Next Gen. We teach, we don't lecture. All right, please pay attention to details. Ensure you are consistent with our lectures, and I'm very sure you will definitely have a positive result at the end of the period. All right. Distinguished professional colleagues, let's quickly look at this analysis of this question. Right. This question is adopted from the ACCA. As well as ICANN, right? So it's kind of complex. When you read it, it's kind of complex, but it is not what? It is not difficult. Now, should we examine this now, or we leave it till Tuesday? Can we leave it? Should we leave it till Tuesday?
Let's diagnose it now and continue on Tuesday.
Okay.
Yeah.
And what of others? Should we continue?